Hi everyone, hope you're all doing well. Today we're going to talk about some stocks that I am watching going into 2024. So these are stocks that I've identified as opportunities and I potentially could buy them. Now, the reason why I have not bought them is there's something still that I don't like about them, and I'll probably tell you what that is. But there's a few things that I'm getting tempted by. Now, I'm not going to lie, I made this list about 2 weeks ago. And as you know, things can change quite rapidly in 2 weeks. So there's a few changes, some that have brought out trading updates that I've gone, oh, that's not good. And there's a few that I've actually, well, one of them that I've actually gone home. So I'll keep that one nice and brief. But every year I like to start identifying opportunities that I might buy in the next year, and these are some that I'm looking at. Obviously, it doesn't mean that I'm going to buy them all or buy a lot of them, just ones that I'm keeping very high up on my watch list at the moment. Anyway, so starting off with this one, which is the mystery stock. So you probably saw me mention on the stocks I'm buying video last week that I bought a brand new stock, and this is the stock. It was supposed to be on this video, but I have bought it, and I didn't think it would happen so quick, but it did. A few things lined up quite well with stocks being sold that I bought it. So there was a stock, or should I say even an ETF, that was supposed to be on this video, but I'm not going to say it just yet. I am actually going to reveal that on probably Monday or Sunday. So I will get that round to you guys soon. So yeah, bear that in mind. The next one is PDD Holdings. This is one that's kind of got my interest in the last few weeks, and then I was waiting for them to report earnings, and then I saw the earnings, and that's fast tracked it forward to this is the number one on this list as that I might buy. So Pinduoduo, they did come out with their earnings this week. They beat rapidly on EPS, and then a revenue growth point of view, 94% year over year. Now, obviously, trading at 32 times earnings for a company that's doing these numbers is absolutely crazy. Obviously, there's that sort of thing that you got to put in that it is a Chinese company, so there's kind of a lower multiple placed on it. But even so, I'm thinking it's not too bad at all, and it's definitely a higher risk company on the list. It's probably one of the higher risk companies that I've been tracking recently. I've not really bought too much high risk recently. I think maybe the last time I bought was maybe last year, a new stock that was higher risk, which was Revolution Beauty, which was a candidate that had all the bankruptcy fears and kind of the accounts were dodgy on them, and I thought, okay, this is a bit too low valuation, obviously a high risk though, but it did work out and we made some good money off it, and this one is probably the highest risk one since then. But yeah, I think that I look at this one and I go, I can get JD Sports for like JD.com for a lower valuation, but it has nowhere near the growth that this has, and the growth that the profitability is ramping up. Like, it's 32 times earnings now, but very quickly that PE is going to drop even more because of how quick that profitability is ramping up, and he's historically trading about right. Like, you look at previously what I did a year ago. The only reason why I've never been interested in this company, to be fair, is that it's never made a profit, but now it is making a profit. And you can see it like they're going to trade around about 32 times earnings, which isn't too much higher than what it normally has traded at, considering now that it's had this boom in growth as well. If you're growing a lot faster, you're going to trade at a higher valuation. And you can see the surge in revenue and profit that's happening here, and also a pretty decent balance sheet as well. Now, most of this growth is coming through Temu. So this is a new platform they launched. They launched this a year ago in July 2022, and it's number one in the App Store. It's taken the whole world by storm, and it's launched in the US. After launching in US and then Canada, it started launching into Australia, New Zealand, and even a few months ago, we had the launch into Europe, France, Germany, Italy, Netherlands, Spain, UK. So, and also eventually into the Latin American market. So the big thing is, like, when I look at something like a JD.com that I own, and that's the one I'm actually thinking about selling and maybe putting into Temu, is that that's kind of a Chinese only play. Most of the revenue comes from China, and we know that sometimes the restrictions that China slap on them. Now, I guess it kind of opens another can of worms that there might be more regulation from the international markets, but realistically, they've got more diverse income, and they've got a lot more markets to go for at the moment. They're still in really early stages, and you look at something like a Shein, for example. If Temu can get even close to what Shein have, that's what's going to cause the big growth driver for the next few years. Now, the big thing that we say is the risk of regulation and how quickly some things can go out of fashion, and teaming might go out of fashion very quickly. But at the moment, it looks pretty good for the valuation, and yeah, I'm really tempted by that one. Next one is Team 17. So this stock has just absolutely fallen off a cliff. Absolutely, it's been devastated. I mean, to say this stock was an £8 stock in 2021, and the stock is now down pretty much 80% since that time frame. Unbelievable. But the last drop was in the last few days. I mean, this drop here, 51%. That's absolutely crazy from Team 17. And the company's definitely going through a few issues, but I don't think it deserves to be as low what it is right now, which is the key thing to say. I'm sure most of you guys have seen Team 17 mentioned before, but they are a independent game developer. Obviously, gaming should be a pretty solid sector for the many years, and they've actually blamed the downturn at the moment into some of the new game titles not being as good as what they were expected. Now, that can resolve itself in the longer term. Maybe there's also the kind of point of view that we're in the environment where spending's being pulled back a little bit at the moment. So they have dropped their EBITDA down and did a profit warning on the other day, causing the stock to go down. And when you do look at the future forecast, you can see now, the profitability that historically was up more towards the 20 million range is going to drop all the way down to 11 million. So it does look cheap on an earnings basis at 12 times earnings, but that's probably going to go up a little bit higher while this profit drop is going on. Now, they are forecasting the revenue to increase and come back, and the profit to increase and go back. I mean, this is analysts though, they're trying to guess what can happen in a year. We could see this take a while for Team 17 to recover, but when I do look at the track record of the company, and they do throw still good amounts of profitability off, they can handle this situation, and hopefully they redevelop some good game titles out there. I mean, financial health wise as well, if I'm going to buy a company that's going to go through a little bit of a troubled time, I want to make sure it's profitable, which it is. It's still going to do good profitability, and at the end of the day, it's still a clean balance sheet. They've got no debt on there. They sit on 45 million of cash on a 235 million market cap, so they've got a good 40 million of cash. A good 20% of cash or to the market cap there. And, if they get back to throwing off 20-ish million of profit, that's going to be amazing amounts of profit to what the market cap's valued at. So, yeah, I mean, ultimately, the big thing here is that can they get back to where they were? And I think they will do, because obviously when you look at the track record of the company, they've got a very good track record. The only thing that's going to be the issue is they are going through a management change, which is the only thing, and I can't believe that something like that you'd call off, in my opinion, right now. You wouldn't do a management change with what you're going through at the moment, but it's got me interested. It's got me definitely really interested. And now the next one is Doc Martens. So this stock was on my list a few weeks ago. Since then, it's actually come out with a trading update, which I was kind of waiting for to see because basically the share price has been on a big wobble for a long time. IPO, it's probably overvalued, as the old saying goes, and you can see here the stock has gone down rapidly since that time frame. And I was kind of going, is this a bit too much? I've done it before where I've bought IPOs after they've IPO'd a few months later that it's initially overpriced, and it's probably overpriced, and then I can buy it at a good valuation. And Doc Martens, I like the brand. It's a good brand. Now, what does make me nervous is around the kind of fashion industry. It's very, very hot and cold sometimes. I've been burnt by that. Obviously, when you look at the likes of Boohoo, that's a prime example of how quick fashion could go in and out. And that's what makes me nervous with this one. So I'd have to get it at a very good valuation. But I'm watching it because I think in the long term, Doc Martens will survive. It will come back around into fashion once again. And it's a good product. Now, like I said, the problem is in the recent earnings, they were worse than what I was expecting. Revenue was down 5%, so they're not growing. But the big thing is when you look at the profitability, EBITDA was down 13%. The profit before tax was down 55%, and after tax down 57%. And the EPS as well was down 58%. And the big issue with that is that this company looks cheap when you go, oh, it's 9 times earnings. The problem is that if this profitability is dropping this much, that's going to really hurt the valuation and then not look as attractive. And you can see here the revenue slowdown that is going on with the company. And you see the profitability drop down from 177 million down to 88 million. And you can see the analysts are forecasting for this to come back and grow again in the next year and the year after. But they do. Analysts are always going to forecast growth. And the big thing is, can they get that growth? I'm not sure. And that's what's made me a little bit more, what I was hoping for to see in this update is something to give me a bit more confidence of like, oh, sales are rebounding, but I'm not seeing that. And the big thing as well is like, I look at Doc Martens, and I don't know if you guys notice the same thing, but I feel like they had a big boom in 2021. Like they came really popular in 2021. And I feel like they've just gone out of fashion a little bit in the last year as well. And that kind of comes to the point of view that it's one of those that I have stuck on the video today because I was going to do it. But realistically, it's probably dropped quite far back now because I didn't get the update that I wanted to see from them. So yeah, I'm going to watch it and see if they have a good Christmas period and sales do start coming back and there's some positives there. But yeah, it's not as high as where it was a couple of weeks ago before this update came out, which is a bit disappointing. Next one's Fiverr. So I've always wanted to own Fiverr. It's a company that I really like the company, but the problem is I can like the company, but I don't like the stock. That's the issue. And I like the company. I think it's a great company. I think it'll do very well. Freelance services in the next few years will grow and grow and grow. And I think Fiverr, I use it myself. I think it's a really, really good product. I've never been able to get over the line on the valuation. Now, I've watched this for a long time. I've been watching stock for probably like 2 years now. And the more and more it goes on, the more this stock is actually getting closer to the valuation where I go, I could buy it. I could buy Fiverr. Now, obviously, they had a big boom during the CV times. Everyone went to work online. Fiverr benefited from that. And then since then, obviously, it's brought so much demand forward. The stock has been killed. But, I mean, it's now down at $26. It's, I mean, the stock's basically not done. Even this year when the stock market's been on fire, if you had Fiverr, you're down on it this year. So it's not participating in the rally at all. And it's actually, you know, you look at 2020, it was $24. You know, from the CV times, if you held through the CV times, at one point you'd have been going, oh, I'm up on this position, it's a 10-bagger. And then once again, that 10-bagger would have come down to being down on the position. How crazy is that from a share price point of view? But yeah, I like Fiverr. And the big thing is that the financials have started to get better in the company now. So if you look at the moment, the current year, the year ago EPS was 0.71. This year it's actually going to be 1.9. Next year it's going to go from 1.9 to 2.24. So that's really good to see. The other thing is from a revenue point of view, this year we're going to grow 7%, which isn't enough to track me in. But looking forward, this year in the next quarter we're actually going to go to 11% growth and then hopefully 12% growth. And then next year we're actually going to 13% growth. So if you're ramping up your EPS like this, your sales growth is going back up to double digit. You are more trained towards a forward times earnings of 12. This starts getting interesting for me. I wanted to see the financials develop and prove to me that they can ramp up this EPS and they can ramp up the revenue growth. And next quarter is a big one, because if they do go up to this double digit growth, and if from an EPS point of view, they go from 0.26 to 0, a double up on the EPS, they're proving to me that they can do it. And then I have a company that I like the valuation, I like the numbers they're doing, I really like the product. I like this. This is a top one that I'm watching in 2024 that I could come a shareholder of Fiverr. I'm really liking Fiverr. The next one's DS Smith. So this is the only, I probably should have stuck Ulta Beauty as well. There's a few stocks that are honorable mentions that I've actually not stuck on this video. Ulta Beauty is a stock that I really want to check out, but I've not had time. They've actually brought earnings out the other day and the stock is up, which is a little bit annoying. But Ulta Beauty is one that I'm also interested in. Another one that isn't on this list, but I'm going to cover it on the Patreon sometime soon, which is Evolution. That looks a really interesting opportunity as well, but I've not mentioned it today because I'm going to be mentioning it on the Patreon in the next couple of days. So yeah, but those are two stocks that could have been on this watch list as well that I'm interested in, but I've not added them on for the reason that one has just had a bit of a pop-up, and also the other one as well is that I'm going to cover it on the Patreon in the next few days. So just thought I'd mention them too as well as honourable mentions. The next one's DS Smith. So DS Smith I am interested in. It's same again, the valuation, it looks a little bit low, but it's going to have a little bit of a jump up in a little bit. So keep that in mind with the PE basis. It does have a 6% dividend yield, which is more the reason why I'm getting in, is that I'm going to get a nice dividend from it. But this company, once again, is below where it was pre-CV. In case you don't know, they're a company that sells packaging, especially packaging for online shopping. So you imagine online shopping is going through a little bit of a slowdown at the moment after such a big boom. So that's going to take its toll on the company for a little bit, but obviously we should see that rebound in the longer term, so I think that's why DS Smith will be okay. The other thing that I would like from DS Smith is probably a little bit more expansion from out of Europe into other places as well. That's what I would like from it. But I think when you look at the track record, very good track record of delivering the profit and revenue, as you can see here. From a balance sheet point of view, it's a really healthy balance sheet as well. They sit on 47% debt to equity, but they do sit on 472 million of cash. Dividend point of view, it's pretty well covered. Obviously, they've got a track record of hiking up the dividend. The dividend is covered by 50% to earnings, which is obviously really good. The only thing that is I would like to see is more insider buying. I thought if you've seen your share price dip from 2021 and it's down at these sort of levels, I'd like to see maybe a little bit of that insider action going on at the moment. But yeah, this is obviously a little bit more cautious than the other ones, a bit more of a safer stock. But I think when you look at e-commerce, it's going to be very good in long term, so I am tempted on that one. And the next one is Nphase. So Nphase is a company that basically had the CV boom, but for them they had the energy boom situation last year. That's what's caused a big issue with Nphase. So the stock went absolutely ballistic, and then since then, around about December 2022, I mean, this has to be one of the, down 60% this year. Not everything's gone up this year, has it? Down 70%, and same again, this stock is about to the same sort of levels it was in October 2022. Now, same again, 25 times earnings. It's not actually true because the profitability is going to be diving in a little bit, so bear that in mind. Now, the big thing is they had is obviously energy prices. Energy prices in 2022 went absolutely crazy, and during that time frame everyone went, oh, if I'm going to get solar, now's the time. And the other thing is interest rates were very low. Since then the prices have gone down, so everyone that brought a bit of demand forward, and also people looking at the interest rates and going, I don't really want to get solar at the moment because interest rates are so high at the moment, and that's been a big issue for them. Now you can see the downturn in the financials as you can see here, which is going to cause the issue, and why the P is probably looking a little bit higher than what it actually is. Now, actually, in a year's time, unless they're forecasting a rebound, which they are going to do, we talked about this, they are going to forecast a rebound, but I don't know how much it's going to be. I don't know how much of that demand was pulled forward last year. And we've seen before, when you have demand pulled forward, it sometimes doesn't only last a year, it can last 2, 3, 4 years. And for me, that's what I'm waiting for. I'm waiting to look at, I think, once they've got Q1 and Q2 out the way, I feel like this company will be in a better place on the comp position, but I don't know how much they're going to recover by, if that kind of makes sense. So I've got to see really the financial turnaround, and I think they will do it because I think solar in the next few years will be very good, and will be still in demand. So I think that we will see a rebound. I'm not sure if we'll see this rebound that analysts are forecasting. We'll see. I mean, if they did that, if I knew they were going to do that, I'd buy that, but I don't know. So that's what I'm kind of working out with Nphase anyway. And also on the balance sheet, not too bad of a balance sheet, but obviously they throw off a lot of cash. Doing a big share buyback at the moment as well, which is really good. You know what? Very quickly, I did give them an honourable mention, but I'm going to stick it on to today's video. So I did mention Evolution. This is going to go on the stock request. I'll give it a really quick one. I won't spend too much time on it because we're going to cover it in more detail on Patreon. But yeah, they develop and have the licensing for live game solutions in a lot of countries. Looks a very interesting company because obviously you're paying, what's the valuation? It's something like 20 something, is it? Oh, it's actually 20. I thought it was a lot higher than that. It's 20 times earnings. And you look at the company, great track record, lots of revenue, lots of profit growth. Financial health wise, as you would expect when you've got that much cash throwing off, no debt on there, a lot of cash going to the bottom line. I mean, they sit on currently 813 million of cash. Potentially that could lead to a lot of dividend being paid. This is, once again, this is definitely on my watch list. I haven't mentioned it in today's, well, kind of have now. I haven't mentioned it today because we are going to talk about it on the Patreon, but that's definitely another interesting opportunity I look at. I just get a bit nervous with gang vibes going on, but there again, gang could only dream of doing that amount of profitability, so we'll see. And the other one is Ulta Beauty, which obviously most of you guys would have heard. They makeup, hair care, skincare products. Brought earnings out last night, so the stock is having a little bit of a jump today. But on a share price point of view, I mean, they've absolutely been destroyed this year. I mean, look at this. Went up for 464, went up to 554. We actually touched the $373 range. We are having a bit of a jump up at the moment on the share price, but it's still low on the share price. I mean, on the valuation point of view, you are paying 16 times earnings. That's not too bad at all. I mean, let's look at what the company normally trades at. So before CV, 29, 30 times earnings. 20 times earnings. So it's historically a little bit lower than what it normally does trade at, but great track record, good revenue growth, good amounts of profit there. The balance sheet, I think, is okay on this one, if I remember correctly. Yeah, so they've got no debt on there, which is absolutely amazing. They sit on 388 million of cash as well, and obviously they're going to be throwing off good amounts as well. Yeah, you're throwing off about $1 billion-ish a year as well, which is obviously really good to see. They currently do not pay a dividend. And I guess the only disappointing thing is that there has been sells more than anything, more than buying at the moment. But they're only relatively small positions that people have been selling off, I guess, really. So, yeah, I would really like to have a look into this one. It's another one that's on the watch list. As you can see, there's definitely still opportunities in the market. You think when we've had the rally that we've had this year, and then you still got, but there's all these stocks that are interesting opportunities. I just need time to do it. I need time to sit down and look at a few of these companies to see if they're a buy. But those are a few of the stocks that I'm looking at in 2024 that are looking interesting opportunities, and I thought I'd share it with you guys because quite often I talk about I own the same stocks, and I own them for a very long time, and I end up talking about a lot of the same stocks for quite often. And I know sometimes you guys just want me to freshen it up and mention new stocks that I have not talked about before, and also rather than talking about what I own, what am I currently looking at, because sometimes it can go a bit unaware, but every week I'm kind of looking at probably like 30-40 stocks every week. Some in brief kind of looks, but some are like really digging into them, and eventually I might get to the point of view where I go, I buy it. And there's other times where I look into a stock quite heavily and I go, I don't really like it. So an example of that this week would be Doc Martens. I was getting quite into Doc Martens and looking at it going, if this is a good update, could be really interesting this. And then I get the next update and I'm like, all them work you start doing and digging into it, and you're like, I can't buy this now because of that update, which is a bit devastating. But there's all that kind of goes on in the background, and I don't always share it, and I thought today was a good time to share it, especially with it coming up to a new year and opportunities that I'm looking at. So yeah, let me know if there's any stocks you're looking at. Is there any on those lists that I shared with you guys that you like as well? Let me know about that as well. But yeah, have a great weekend. See you in a bit.